the beta A. To de-gear the proxy, we need to use the proxy company's gearing. Remember, equity is 2 and debt is 1. Make sure you get that the right way round. Read that carefully. It's the ratio of E to D, which is 2 to 1. And the re-gear, the beta, would be therefore E equals 3 and D equals 2. So we'll start with beta A is going to be 2 over 2 plus 1 times by beta E. It's going to be 2/3 times by beta E, and beta E is 1.5, and therefore beta A will equal 1. Now we've got to re-gear. Now the simplest way to re-gear it is to reverse the formula, put the bottom on the top. So now beta E equals VE plus VD over VE times by beta A. Now to find beta E, we're going to look at Willox company gearing, which is here, 3 to 2. So it's 3 plus 2 over 3 times by the 1 which we got from proxy beta A. So 5 over 3 times 1 is 1.66 recurring. And we've been asked to put it to 1 decimal place. So be careful, it needs to go to 1.7. And there we have it. We have the answer there, 1.7. So let's just discuss those distractors. 0.6 would be the answer if you'd done part 2 wrong, if you hadn't reversed the formula. So you times the beta A by 3 over 5 instead of 5 over 3. And the 1.3 would be the answer if you'd got debt and equity mixed up. And then 1.5 is just the proxy equity beta value, and you hadn't done any de-gearing or re-gearing. Okay, so now we're on question 7, and this is a discursive question in the risk management area of the syllabus, specifically interest rates. Now we've got 3 statements here, and they're asking us which ones are true. You've got 3 options there, so we'll have a look at those in turn. The first option says a negative interest rate gap occurs when interest-sensitive liabilities maturing at a certain time are greater than interest-sensitive assets maturing at that time. Well, let's have a look at the theory about that. So the interest rate gap is defined as interest-sensitive assets minus interest-sensitive liabilities. So that is correct. We've just got to decide whether it's negative. And it's negative if the interest-sensitive liabilities are greater than the assets. So therefore that is true. Now number 2 says an inverted yield curve can be a sign of upcoming recession. Well, let's draw the yield curve, the normal yield curve, and then discuss what happens when it's inverted. So here is the normal yield curve. Interest rates are increasing with the term of the debt. So an inverted yield curve would look like this. So here, interest rates would be falling with the term of the debt. Now, one of the theories of the yield curve, and there are 3, remember, is expectations theory. The other one is liquidity preference theory, and the other one is market segmentation theory. Well, this one is all about expectations theory. And if we see the yield curve increasing with the term, we would be expecting interest rates to be going up, and therefore that would be a sign of a boom. If it's inverted, that means we're expecting interest rates to go down in the future, and that would be a sign of a recession. So number 2 is true. Then number 3 says liquidity preference theory is where investors have a preference for shorter maturity investments and will therefore expect those investments to have a higher yield. Well, liquidity preference does say that investors do have a preference for shorter mature investments, but that demand means that the yield would be lower. It's actually the opposite. The yield will be higher on the longer term investments to compensate investors for investing over a longer period of time. So number 3 is not true. The answer is 1 and 2 only. So the next question is question 13. And here you have to find the current market value of the debt to the nearest dollar. So a company has some redeemable debt with the following features. The coupon rate, which is the interest rate on the debt, is 8%, and it's redeemable in 8 years' time, so that's the term of the debt, and it's redeemable at a premium of 10%. So remember, the nominal value of debt that's traded is always $100. So the premium works off the 100, and therefore a 10% premium would mean it's redeemable at $110. The required return for the investor is 7%, and the tax rate is 30%. There's your first distractor. The investor receives the pre-tax rate at 7%, and so we don't require that 30%. That is when we're calculating the cost of debt to the company. So when we find this current market value of the debt, we're looking at the cash flows that the investor will receive. So I'll lay that out for you. We will then need to find the present value of those cash flows by using the discount tables to find the discount factors and the annuity factors. So the first cash flow to note down is the interest receivable. That will be 8% on a $100 loan note. And they're redeemable in 8 years' time, so we're receiving that from years 1 to 8. So that'll be $8. The next thing they receive is in year 8, the premium on redemption, which we've already said is $110. We now need to find the discount factors to find the present value of those cash flows. So let's refer to the tables. So the first factor we need is the discount rate to apply to the redemption value. And that is at 7% for 8 years. So that'll be 0.582. Then we go to the annuity table and we look at the annuity factor at 7% for 8 years, which is 5.971. Then we now times the interest by the annuity factor, which is 47.768, and the 110 by the present value factor is 64.02. We total them up and we'll get 111.788. Now remember, we have to put that into the nearest dollar. So the nearest dollar is 112. Let's pop that into the answer. So I put that in as 112, but just see if you did try and put that in dollars and cents, which would have been 111 point. Oh, I'm not allowed to put a point in. So therefore that is good. It will remind you. So let's put that back to what we want it to be, which is 112. So we're now on question 14, and this is from the cash management part of the syllabus. You're being required to use the Miller-Orr model. Now the Miller-Orr model, lower limit plus 1/3 of the spread. Now we were given our lower limit in that question. It was 15,000. The question asked us to find the maximum point, which would actually be the lower limit plus the spread. And the spread is there for you to use those variables given in the question to calculate it. So let's show you how to use that formula. So I've written out the formula for you, and now we're going to complete it. With that, I think we've come back to me. Just checking. Lucy, am I back online? Okay, it's just that the slide isn't quite the same. Let me just go back to the Q&A.
You just need to move the slide along and it will move on to your Q&A slide.
Yeah, I've got it. Yeah, I've got it now. So the Q&A, I've been answering lots of questions on the on those mock questions for the MCQ section A. one of the main questions that came up is the question when we were doing the valuation of the bond for the investor. And a lot of people were misunderstanding the fact that we didn't use that tax rate. That tax rate is a corporation tax rate, and that's for the company. We use that tax deduction when we calculate the cost of debt. When we're calculating the market value of debt, we don't use that tax deduction because it's from the investor's point of view, and they get interest, which is pre-tax. And so the valuation of a bond has to be used for pre-tax. And so you must remember that. That is a really valuable technique. These questions come up all the time. So that was one of the main questions. Right, I'm going to now have a look at the next one, which is the section B mock debrief. Now this is the valuation question, the business valuation question. I got a question earlier also on the fact that risk management and business valuations are tested mainly in the MCQ section of the syllabus. Now that is clearly stated in the syllabus that they are tested in the MCQ sections. However, I'm not going to say that you're definitely not going to get some sort of question in section B. You won't get a calculation, but you might have to refer to a theory in those two areas. So don't rely on it. I mean, you can pretty much rely on it being a big question in an MCQ. So one of the cases, for instance, from the risk management area or the business valuations area. But I would definitely not see it as a full section C question. No, so that's the right answer. Okay, so let's move on to the section B mock debrief. That was when we used to test it in section C, and there was two answers given where you could use the growth or you could just use the earnings yield without the growth. And so basically now it's tested in section B. It's only ever used without the growth. So you just take the earnings yield and you don't need to take into account the growth in earnings. We do, however, still use the growth, obviously, in the dividend valuation model. So when you're using the valuation for dividends, then you need to put the growth in. So I'm now going to move on to our final section, which is the section C mock debrief. So here we have Damerel Company. Damerel Company is a working capital question, and it has 3 requirements. 2 are discursive and 1 is a calculation. Having a look at the scenario now, you can see you've got some statement of financial position extracts showing the non-current assets and the working capital. 2 notes beneath the statement of financial position extracts. The first one is telling us all about the current assets and how much we have as buffer inventory, how much the receivable balance fluctuates with its lowest, and the cash balance fluctuates with its lowest. This is telling us these are permanent current assets. The second note is telling us all about a supplier discount offer. Let's now have a look at the first requirement. The first requirement says discuss the different strategies for funding working capital, and from the figures, determine which strategy Damerel Company has adopted. This is for 9 marks. So the first part of the requirement is to discuss, and the second is to use some analysis to come up with the strategy that Damerel has adopted for funding their working capital. And here is the marking scheme. It's very clear where all those 9 marks come from, but there is a pitfall, and it's the discussion of permanent versus fluctuating current assets. You can't explain those 3 approaches, aggressive, conservative, and balanced approach, or matching, easily unless you understand the difference between permanent and fluctuating current assets. Because permanently in the business is the base level, and fluctuating is seasonal. You then need to go on to the analysis of Damerel and those calculation marks. So here I have a real student answer for you, which I'm marking on the practice platform. We can look again here at the marking scheme and allocate the marks from it. So as I can see, they've detailed 3 strategies. They've then talked about the cheapest form of finance as an overdraft, and that keeps costs low. They've then done some analysis on Damerel's strategy, and they've come up with a solution to their approach. What they haven't done, though, is those first 2 marks. They have not explained permanent and fluctuating, so they'll get 0 marks for that. They have done a bit of a discussion based on risks and costs, and so I'm going to allocate half a mark for that. They then have discussed the 3 strategies in their own words, which are all correctly explained. So 1 mark each. And then when we come to the analysis of the strategy, they have done some analysis based on the total current assets and the total current liabilities. And they've looked at the fact that the current liabilities is funding 31% of the current assets. Now, this is not strictly the analysis that we wanted. We wanted them to use the permanent current assets in the business to work out the strategy. So if we look again at the question, you'll see here, these are the permanent current assets in the business, and they should have added those together and compared them to the current liabilities. Looking at the model answer, you can see that this would mean that 3.3 is permanent in the business, and that would leave 1.475 as fluctuating. And as the fluctuating matches the current liabilities of 1.5, then that would mean we're funding the fluctuating current assets with short-term funds being current liabilities, and therefore we must be funding the remaining, which are the permanent current assets, with long-term funds. This would mean they're using a matching approach to funding. This candidate has come up with a conservative strategy, but they will still get some own figure rule marks for this. So I'm going to allocate them half a mark for their calculation and half a mark for their answer, but that would be an own figure rule. So overall, this candidate has scored half marks on this. The second requirement is to evaluate whether Damerel Company should accept the early settlement discount offer from its main supplier. All the information you need is in that second paragraph. Now, you're used to doing this from the receivables point of view, but this is from the trade payables point of view, and this will need practice. There is a past exam question called Nasud Company, which is in Practice Exam 1. So you should go and have a look at this after doing this mock. Here is the marking scheme. There's 5 marks going. Again, we need to look at the own figure rules here. If the change in payables is incorrect, that will affect the increase in the finance cost and also the net benefit of accepting the discount. So those are own figure rules that should be followed through. Finally, if it changes the comment on your financial acceptability, and it's different from the model answer, but it's correct based on your answer, then you get that mark. So here again, we have an example student script. On the left is the paragraph that we need to answer the question. And it says the credit terms from its main supplier is 30 days, but it's been paying on average at 40. Purchases from this supplier are 3 million per year, and Damerel has been offered a discount of 0.5% if it pays within 15 days. The administration costs will increase by 600 per year if the early settlement discount is taken. Damerel's funding costs for working capital are 6% and assume 360 days per year. Always read to the end of the question. So if we look at what this candidate's done, They've used the spreadsheet functionality beautifully. It's clearly laid out, it's clearly labelled, and I can see the follow-through calculations to be able to give them some follow-through or own figure marks. So now let's allocate those marks. That settlement discount has been calculated accurately, and that gets 1 mark. The payables now says it's 30 days. Now that might be the credit terms, but that's incorrect. It's the 40 days that we should be using to compare with the 15. They've also used 365 days instead of 360. However, they have correctly used the 3 million purchases to calculate the total payables that requires funding. So the calculation for the drop in funding is correct based on their figures, and then they've applied the 6%. So we can give an own figure rule for that finance cost. They get 0 marks for the change in payables, but they then also get an own figure rule for the net benefit. They've missed out the administration costs increase, therefore losing half a mark, and they've also not really commented effectively on whether it's acceptable. They've just said yes. I'm not going to give a mark for that. You need to be writing a whole sentence. So in summary, they've received 1 mark for the settlement discount, 0 marks for the payables because they incorrectly used the 30 and 365. They received an own figure rule mark for the finance cost, correctly using their own figure, and again the net benefit is correctly calculated based on their figures, but without the 600 administration cost increase. They didn't say properly that it was financially acceptable. So overall, they're going to get 2.5 marks. Finally, we come to C. This is for 6 marks. This is a really open-ended question. It says, discuss the difficulties that small and medium-sized businesses can come across when sourcing funding. There is a lot to say on this, and the marking scheme reflects this, so you'll have to plan your answers carefully. There are many more marks here than 6. In fact, there's 10 marks going. You need to be careful when you're marking this for yourself. Don't expect that your answer should match the model answer. It's the marking scheme that matters. And if you've written something in your own words and it doesn't match the model answer, you will still be given credit for them. Now, there is a technical article on SME funding that you should read. This would really help you with this question. Okay, so this is the final part of the student answer. Remember, the question is discuss the difficulties that small and medium-sized businesses can come across when sourcing funding. So you need to discuss the difficulties and answer the question. Now, this student has tried to do that. They've said the difficulties are they are seen as risky. And they've explained in 4 points why they're risky. However, we don't like bullet points. We like full sentences. And so really they should be explaining that limited track record with a full sentence. And they should also be explaining they don't have assets to use as security as a full sentence. If you look at the model answer, they have explained it. Here, the risk to the investor is also increased because businesses often do not have a proven track record and their accounts will not have been scrutinised as much as those of a quoted business. You just need to explain your points and not state your points. If we then move on to those 2 sentences below their points, they've also said they have a funding gap because they're not seen as an attractive investment. You haven't really explained what the funding gap is to fully get the mark for that. Although it's obvious to you, it's not obvious to the marker that you know what the funding gap is. So define it and then you'll get the mark. The funding gap is the difference between what small, medium-sized enterprises desire as financing for their investments and what they're able to achieve from external investors. The candidate then goes on to say they're not large enough to float on the stock market. That needs to be explained. So what? It means that they will struggle to raise equity finance from the markets. They'd have to look privately to venture capitalists or business angels. And then they go on to say getting loans are difficult because they require security. That is a good point. They don't have many assets available, and I think that point is clearly explained. So I'm going to allocate 1 mark to this risky and explain by the limited track record and the limited controls and don't have to be audited. I'm going to allocate 1 mark to the assets to use as security linking to this sentence here. I'm then going to allocate a half mark here and a half mark here. So overall they've achieved 3 out of the 6 marks, but it could have been so much better if they'd used full sentences. Thank you for listening to this Section C mock debrief. If you have any more questions on any of the sections A, B or C, then your chance to ask them is now. Insight on where you can go and do some further practice on the Section C question that I've just gone through. So question 32, Damerel, these are some areas where you can go and do some further practice. So if you're wanting to understand working capital funding strategies and how the questions are asked, you can go and look at Dusty Company, which is in the September-December 2019 sample paper. You've got Pumis Company, which was from March-July 2020, and that one describes working capital investment and funding. And that was one of the questions I was asked. They have similar terminology, but they are described differently. So go and have a look at Pumis Company and you'll understand that in a bit more detail. And then you've got Nasud Company, which is basically a direct copy of this question on the supplier discount side. I did have a question that somebody's just asked me about that supplier discount. Do we take into account the discount on the purchases figure when we're calculating the payable days? Now, I have seen that answer in questions in exam kits by providers, but the ACCA answer is basically done for trade receivables and payables, is based on the undiscounted version of the sales and the purchases. So your answers should reflect that. The technical article Business Finance for SMEs is also a podcast, and so that's really worth reading and understanding the risks, the issues that SMEs have. They have a funding gap and they have a maturity gap, and that explained really clearly in that technical article. It also goes through all the different types of financing available for SMEs, which is exactly what could be tested. And it was tested in Dink Company in September-December 2019. So you need to be able to describe some of the different types of funding that an SME can get. But please, please remember, do not rote learn it. Don't just write down everything you know. Answer the question, because that particular question, from memory, does say describe 3. Okay, so you don't need to describe 6. You need to describe 3 well to get those marks. So don't just state them, explain them. And this is something that every time students need to get clear. You don't state something, you need to explain it. So when you're in the working capital side of Demerel, and we were explaining the working capital funding strategies, the question never told you what the funding strategies were. So you had to remember they were aggressive, conservative and matching. And so the marks are going for knowing that, but then describing it in your own words. Okay. So hopefully that's given you some hints of where to go and do some extra practice. So now this is your turn. Now, the other question in the Section C exam, part of this exam was a net present value question. And it was based on quite an old question back from 2014, I think, from memory, where the accountant had basically done a junior accountant had basically done the net present value calculation incorrectly, and you had to correct it. But I want you to focus on the written part of that question. And I have a poll for you here. So the written part of that question was only for 3 marks, but we've seen this question time and time again in past exams. And this is an example for me to show you. This is where a student will have potentially learnt an answer to a question and then decided to write that answer to this question without really focusing on what the question is asking. So this question is asking, if the project is to go ahead, the loan funding used would represent a significant increase in debt funding for High-M company. Explain why this might make the current WACC inappropriate to use. Now, previous questions have said, explain why WACC may not be appropriate to use in project appraisal. That's a much more general question, okay? And so this student has learned that answer, and I'll show you. They've basically written that out. They've written business risk, finance risk, size of project. That's not answering this question. This question is specific about finance risk because it's increasing debt funding. So you need to be careful about rote learning answers. You don't just think, oh, I've learnt that, I did that question, I've got it off, and throw it down. You need to apply the theory to the question that's asked. So have a little look at this question. What marks would you give this student bearing that in mind? You can give it him or she, 3 marks, 2 marks, 1 mark, or 0 marks. And then I'm going to post up the poll for you. So bear in mind, do you think they've answered the question that's been asked? Okay? Or have they just answered the question they want it to be because they've learnt it? So I'll give you a few more 10 seconds or so just to read that and decide how many marks you'd give it. So it's 3 marks, 2 marks, 1 mark, or 0 marks. Right, I'm going to move on to the poll. So please start putting your answers in and we'll debrief it in a minute. I'm seeing answers going in the Q&A. I'd put it, can you answer it on the poll, please? Okay, so I'm going to move on and close the poll and see what everybody's put. So we have the overall majority going for 1. We have the next would be giving them 2, and a minimal amount would be giving 3 and 0. So well done, the majority, because that's the answer that I would give this student. So I would give this student 1 mark. So I've marked this on the platform so you can see how this works. I know it seems weird, but the little tick mark with a 0 means they're not getting any marks for that. And they're just getting 1 mark for that final sentence. And this is why. So these are correct, right? So it is correct that business risk, finance risk, and the size of the project should not change, and it should be a small project. But they're not answering the question, are they? The question specifically asked about finance risk, and so these don't carry any marks. But also they're bullet points, aren't they? And we don't like bullet points. They need to be explained. So the question that they're getting the mark for, or the answer they're getting the mark for, is basically they've explained that increase in financial risk and WACC will need to be recalculated. But I want to know what is the actual effect of this in the WACC calculation. So please clarify to get more marks. So to get more marks, the student needs to say, explain the effect fully. Remember the traditional theory of capital structure. Proportionately more debt reduces WACC as it is cheaper, but WACC will increase due to the cost of equity increasing as shareholders see risk increasing. So that would therefore then get them up to the full 3 marks. So they're explaining that financial risk means the WACC is inappropriate because it's changing, needs to be recalculated, and then you need to explain why financial risk affects the WACC calculation using the traditional theory of capital structure. So well done those who all gave it 1 mark. Hopefully you're learning that you need to write in full sentences and explain the question that's actually asked. So further practice on HIM company, I referred to that previous past exam question, which was from December 2014. You should be able to find this in the approved learning providers exam kits. So that's Often Company, December 2014, which was redrafting the net present value and commenting on the errors. Vixen Company is from June 2017, and that is in the past papers in the ACCA website under Financial Management Resources. And it basically uses those expected values which you were expected to use in HIM Company with a net present value with inflation and tax. TUFA and Dienler Company are those questions where I'm showing you discuss the circumstances it's appropriate to use WACC. Those were those rote learn answers in my previous example. So by all means go and have a go at those questions, but make sure that you don't just rote learn. You think, right, I've learnt the theory now, I need to apply it to the question. And then if you need some more understanding of optimal capital structure, then go and have a look at the technical article. There's a whole host of resources and technical articles on the ACC website that you can use, and it's really important that you do use them. Okay, so I think we're now on to the main Q&A. Lucy.
Great. Okay. So firstly, thank you for that session. That's been fantastic. You've managed to get through an incredible number of student questions as your videos were playing. So that's brilliant. We have got some time now just to share some questions more widely. So I'm going to kick off by asking you a few questions that have come in around exam technique, exam approach, so some slightly more general questions. And then I'll ask you to, I've created a folder for technical questions in the Q&A box. And I have been moving some of the things that have been coming through as you've just been on your last few slides. I've been moving those across, so I'll invite you to have a look